Hello, this is Jay O'Neill. I'd like to thank U.S. Grains Council for the pleasure and the honor of helping out with this presentation on ocean freight markets. Today we're going to talk about dry bulk, containerized ocean freight, and then take a look at what's happening in U.S. grains markets. As you see on this chart, and as we go forward and we start to look at dry bulk freight, we have to understand a few basic issues. First of all, at the beginning of this year, the dry bulk fleet was comprised of 12,312 vessels with a cargo carrying capacity of 912 million deadweight tons. And you'll see that on that green bar graph in front of you now on the screen. You'll also notice that the size of the fleet has not changed dramatically over the last few years. And then when we're talking about dry bulk freight and dry bulk vessels, we have to understand that there are different size vessels used for different commodities and for different markets. There's a line drawn about 2/3 of the way down this chart, this PowerPoint slide, and that green line is more or less the differentiation point between what we use for grain and what is generally not used for grain cargo movements. Grain cargoes are going to be handled in the Handymax, Handysize, Supramax, Ultramax, the Panamax, and the post-Panamax size vessels. And that's what is on the upper part of this screen. The Kamsarmax, the Cape-size vessels, and larger vessels are generally not used for grain. And you'll see on the next chart how that breakout compares. So we'll be talking mostly about Supramax, Panamax size vessels when we talk about grain movements. This is a breakout of cargo utilized in different vessels. You'll see the very large ore carrying Cape vessels. Those vessels can go from 140,000 tons up to 400,000 tons. Those Cape-size and larger vessels are utilized in the iron ore and coal trade, largely. Iron ore, coal, and bauxite. It's not until we get down to the next size vessel, the Panamax size, Panamax, Supramax, Handymax size vessels, that we see grain really come into play. Panamax size vessels, of course, are going to carry between 55 and 75,000 metric tons of cargo. But again, you'll still see that coal and iron ore are a substantial market for coal and iron ore. And then as we go down a step further in the Ultramax, Supramax size vessels, you'll see grain is utilized there. That is carrying grain, as we are doing in the Handysize market. But there's quite a variety of other commodities that compete for space on these vessels. So in the Supramax, Handymax, Handysize vessels, you'll see we have bauxite, fertilizer, nickel ore, steel, cement, petcoke, salt, and other small commodities that are again competing for space. So when we're trying to charter a vessel, or when we're talking about ocean freight market rates and a grain market, we're not just looking at what's happening in grain industry markets, but we have to also be aware of what's happening in the coal market, the iron ore market, and these other commodities that are competing for space. Grain actually comprises about, depending on the year, 12 to 14% of dry bulk cargo trade. This past year in 2021, grain accounted for about 12% of dry bulk cargo. And here again, you'll see that iron ore and coal were the major two commodities, and then other minor bulks that we mentioned on the previous slide comprised 37%. So once again, grain is not the key mover. Grain does not necessarily lead the parade, if you will, the market movements up or down. It's more what's happening in the coal and iron ore markets that tend to be the influence factors when we're talking about grain rates or dry bulk rates in general. And since we are talking about iron ore and coal demand, it's very important to realize that 2/3 of all coal and iron ore global trade depends on China. China being by far, the major buyer of coal and iron ore in global markets. And therefore, 100% of dry bulk freight is impacted by the size of the Chinese markets. As the Chinese cargo demand moves up or down, so does ocean freight rates and ocean freight markets. Capesize FFA indexes, and FFA is the Freight Forward Agreement traded on the Baltic Index. FFA contracts are the futures market for freight. And the Capesize FFA index rates have already surpassed $65,000 a day, with spot rates actually exceeding $85,000 per day. We talk about the dollars per day because a vessel owner really is not looking at whether or not his vessel is earning $30 or $40 or $50 a ton. The vessel owner is concerned with how many dollars per day am I receiving for my vessel. So it is the daily hire rate that is watched by vessel owners and vessel operators. And then once we establish that vessel daily hire rate, you can extrapolate what the cargo rate might be in dollars per metric ton. The all-time high for the FFA futures market for dry bulk freight in the Capesize market was $300,000 per day back in May of 2008. We use the Capesize market as the barometer because, again, that tends to be the leading indicator in dry bulk markets. Now, if you're a vessel owner or a vessel operator, you're certainly hoping that we'll be able to go back and touch those highs again, those 2008 high rates of $300,000 a day. And that's what they're hoping for. We're nowhere near that rate right now, but it gives us a point of reference. And aside from the general supply and demand dynamics, how much cargo demand is there, how much dry bulk freight is available, aside from that, we also have to watch the port congestion rates. Right now, about 16% of the dry bulk fleet is tied up in some global port waiting to unload or load, and that also creates inefficiencies, and those inefficiencies in the fleet create higher rates. The Capesize index on the Baltic Exchange has been quite volatile this year. You'll see by this chart, as we go back to the beginning of the year, there on the far left, December in 2020, moving into January of 2021, dry bulk index was fairly low. It was down around just below 20,000. But as we got into the summer, June and July, August, September, October of this year, you'll notice how we saw a dramatic rise in the Capesize Baltic Index. Index jumped from below 20,000 to up of just slightly below 90,000 on the index rate. And then we saw a crash here in November where rates dropped again down below 30,000. And here in late November, going into December, we've seen rates try to recover from that drop-off. And we thought the market, or at least vessel owners thought the market, was heading right back up again. But in the last week, we've seen softness or weakness again start to influence the market, and the index has started to drop. So the one thing we can derive, the one takeaway we can get from this chart is we are certainly living in volatile times, and volatility is going to continue to plague the market going into 2022. It's going to be a very up and down affair. Panamax markets follow the Capesize market, so you'll notice a similar pattern occurring in the Panamax vessel freight market. And if we looked at Handymax vessels, we'd see a similar chart. Big rise in rates going up into October of this year, a drop off in November, attempt to recover in December, and now kind of a back and forth market as the market tries to get new direction. And talking about grain specifically now, we look at the cargo demand, the grain cargo demand globally from the year 2019 through 2021. I think the most significant thing about this chart is the dark blue column to the right of your screen on the bottom, and that dark blue represents Chinese demand. You'll notice that if we go back to 2020 and prior, that we did not see much grain demand coming from China. But as we move through the year 2020 and into 2021, we've seen a steady increase in Chinese demand for grain. Chinese demand for grain now accounts for about 23% of all global commodity demand. So here again, we have to note that it's China that tends to be moving these markets, both in the dry bulk commodities for coal, for iron ore, for bauxite, but also for grain. What China buys or does not buy, as their buying patterns move up and down, it has a dramatic effect on our markets, both our freight markets and on our grain markets. So what happened in 2021? Well, we saw dramatically increased demand coming from China. Increased demand for coal, for iron ore, for the minor bulks, and for grain. And we have not seen a dramatic increase, and we have not seen an uptick in the new vessel order book. In other words, vessel owners are not ordering a lot of new vessels to be constructed at the moment. And that's largely because they have recently, over the last 13 years, suffered through very poor economic results. And therefore, they have reduced their shipbuilding activity, waiting to see if it will be economically attractive to start to build new vessels again. So, over the last few months, we have seen dry bulk rates reach 13-year highs, but still not very many vessel owners are anxious to run out and order new ships. This is a chart I've kept that shows dry bulk rates in dollars per metric ton between the U.S. Gulf and Japan. We could also say whether it's U.S. Gulf, Japan, or Taiwan, or China, those rates are all within $1 a ton of what you see in front of you. And if we look back to 2003 all the way through going into 2007, you'll see that long period of time of low profitability for vessel owners, and therefore not much of an expansion in the dry bulk fleet. And then what happened in mid-2007? Well, we had the Chinese Industrial Revolution, when China was building new cities, new power plants. They needed steel, they needed coal, they needed everything in the way of commodities. And the dry bulk freight market found itself without a sufficient amount of ships to meet the new incoming demand caused by that Chinese Industrial Revolution. And that, of course, took us way up to all-time record high rates in dollars per metric ton. U.S. Gulf to Asia reached up to just over $140 a ton, a metric ton, to haul corn or wheat or soybeans to Asia. Now, you'll also notice that as that economic demand slowed after 2008, that the dry bulk fleet actually grew at such a rapid pace that it outpaced cargo demand. Chinese cargo demand then dropped off, and going into 2009, 2010, and ocean freight owners once again found themselves, as we say, holding the bag. They had paid a lot of money to build new ships, and now the market no longer supported all that new construction. And we went through the period that we just mentioned. We just talked about that 13-year period from 2008 going into 2021, where vessel owners again went back to a time period of low profitability. And that again caused them not to be very excited about ordering new vessels. Now, of course, vessel owners are hoping, they're expecting and very much hoping that their time has come once again and rates will go back and try to mirror what happened in 2007, 2008. So far that hasn't happened, but their hopes still spring eternal. This is a quick picture of the daily hire rates in the market just over the last month and a half. And just in the last month and a half, again, you'll see that volatility. Cape-size vessels in December traded up over $83,000 a day. They dropped to $22,000 a day. And at the moment, we're probably looking at a rate that's close to $31,000 a day here on the 15th of December. Panamax vessels, they followed the Cape direction, and the Panamax traded up over $38,000 a day, down to $21,000. December 1st was $26,000 per day. And if we were to look at that today on the 15th, we would probably see that again down around $23,000 per day in round figures. But you'll also notice that there's an inverse in the market. The market has been willing to pay what it thought was necessary in the nearby market, in the 30-day shipment period. But it has not been as excited about paying up high rates as we go into 2022. So you'll see a bit of an inverted market there. You'll also notice that the smaller vessels, the Supramax, and the same would be true for the Handymax vessels, that those smaller vessels have actually held their value better than the Panamax vessels and better than the Cape-size vessels. They haven't been quite as volatile. When we look at that dollars per metric ton, in the current market, we're probably looking something close to $70 a metric ton from the US Gulf to China or Japan. We're looking a bit lower than what we had at the height of this market back in October. We had rates that touched $91 a ton from the Gulf and from the Pacific Northwest, the US West Coast to Japan or China. At one time got up to $50 per metric ton, and in today's market we're between $37 and $38 a ton for that route. So here again, volatility has prevailed, and I guess I have to expect that volatility will continue as we go into January, February, March of 2022. This chart just very quickly shows us graphically where that new vessel order book has been trending. And you'll see going back into 2009, going forward, vessel owners were not very aggressive at all in running out and ordering new ships. So we have gone from a period of time now where cargo demand has started to increase once again, largely due to China, but vessel capacity has not been building. If you want to go, or if we look forward by vessel owner and market expectations are that cargo demand this year will grow by about 7%, but the dry bulk grain fleet will only grow by about 2.7%. And the next graph there in the middle is for next year, 2022, and the next one to your right is for 2023. Again, in each one of those years, we see the expectation or the projection that cargo demand, if it remains healthy and strong, should outpace vessel growth. And that should help support vessel values, both in dollars per day and in dollars per metric ton. So the dry bulk outlook. Well, the dry bulk dry bulk outlook is going to greatly depend on the global economic recovery as we come out of COVID and the different variants that come from the COVID infection. How fast will world economies, not just the US, but US, Europe, Asian, South American markets, how fast will they recover and how strong will they be able to maintain as we work through these different COVID cycles? And understanding that vessel owners have suffered through 13 years of poor economics in the dry bulk sector, and they are certainly looking and pushing for rates to go higher. The order book is low at or slightly below 3%, and much will depend on China. Will the Chinese demand for all raw materials, coal, iron ore, grains, will Chinese demand for those raw materials remain strong going into 2022 and even out into 2023? Or, as we have seen in the past, might they drop off? Might they be reduced? Increased demand or continuing demand for China will be a definite support issue for dry bulk freight markets. But if that demand should back off a little bit and become slightly lower, it certainly would have an opposite effect for dry bulk markets. The other thing that is happening in all markets, whether it's dry bulk or containerized vessels, is the IMO, International Maritime Organization, has set decarbonization targets for vessels. You may recall at the beginning of 2021, CO2 emissions were mandated to be reduced from 3% down to 0.5% coming out of the exhaust emissions from a vessel's smokestack. And as we go forward into 2023 and even looking farther into 2050, the mandates are expected to head from 0.5% CO2 emissions down to 0% CO2 emissions. So the global freight industry, dry bulk and container, has to ask itself, and certainly is asking itself, how do we meet those targets? Well, every vessel owner, aside from wondering about the general economics of ocean freight right now, is it wise to build a new ship or not? They also have to contend with the question, what type of fuel, what type of engine should I install in those new ships? What type of fuel will those engines burn? And in order to meet lower CO2 emissions as we go towards 2030 and forward, vessel owners have to ask themselves, will my vessel be burning low sulfur fuel oil, LSFO, low sulfur fuel oil, or will they be burning high sulfur fuel oil with scrubbers installed on the stacks to clean the exhaust? Or alternatively, should I build a ship that operates on LNG, liquid natural gas, or methane, or hydrogen power, or ammonia, or some type of biofuel, or even nuclear, or a combination of propulsion with sail, wind sail power? All these important questions, critical questions that vessel owners must answer before they order a new ship. What is going to be economical to build? What fuel is going to be economical to burn? And what fuel will be readily available at ports of call for vessels when they need to take on fuel? Tough questions. Container markets. I think we all know that the container markets were extremely volatile and disruptive this year. In February of 2021, we saw the market go straight up in the air as far as demand for containerized products. As we went from February to March to April, port volumes on the west coast of the United States at LA Long Beach jumped by as much as 43% as consumers, as COVID demand and economic stimulus packages put money in the pockets of consumers, consumer demand rose sharply. And Hence, we've had port congestion, we've had logistical difficulties, and what was once a small container new order vessel book has turned into a big volume new vessel order book. Quite the opposite of what we've seen in the dry bulk fleet. Every container shipping line has ordered new ships, and they've ordered as many new ships as the shipping construction yards can physically handle. So even if you want to build a dry bulk ship today, most ship construction yards are going to tell you, get in line. We have 2 years worth of orders from the containerized industry. So what's going to happen? Well, we do know that shipping line profits are at all-time high levels. Shipping lines profits are in the billions of US dollars. They're having a very good year, even though consumers and shippers are having very, very difficult times with the logistics. Logistics have been a mess, but they've been a mess not just because there are not enough vessels. Frankly, I think there are enough container vessels. What we have is a very difficult logistical pipeline. That logistical pipeline has been complicated by a shortage of empty containers, a shortage of skilled port labor, both in Asia and in the United States and in Europe, a shortage of warehouse workers to handle the increased volume of consumer goods and orders, a 30% shortage of truck drivers in the United States, a shortage of flat rail cars to handle containers from the ports to the interior, and a large shortage of container chassis to put containers on so they can be moved by truck. So it's a complicated dynamic that goes beyond shipping lines. It deals with the ports, it deals with labor issues, it deals with technology, it deals with all aspects of logistical movements. This is also what has caused the problem in container lines not wanting to wait for grain shipments to arrive at West Coast ports and have been taking an increased number of empty containers back to Asia just to meet the increased consumer demand. What should happen? Well, I think many of us were hoping that by the time we reach December of this year, of course we're in December right now, that some of those logistical concerns might have abated, they might have improved. But that has not been the case. We're still living with very restrained, very difficult port and interior logistical problems. And most estimates right now are those logistical challenges will last probably into the middle of 2022 before we can hope for very much relief. So keep your fingers crossed. And then, of course, next summer, when we get into June of 2022, the West Coast Longshoremen's Union, the ILWU, labor contract is up for renewal. And that is expected to cause labor disruptions. So be careful as we go out towards the summer of 2022. There's some other potential problems on the horizon. Grain markets. Well, we need to spend a couple minutes, I guess, now just talking about grain markets as opposed to just the ocean freight. And we have to take a quick look at corn, wheat, and soybeans because those markets all have an interrelationship. One commodity is not going to go up or down without having a pull effect on the other commodities. And I think the biggest dynamic that is at play right now in global grain trade markets is what we call the bottom line. And the bottom line is how much grain is the world producing globally and how much grain is the world consuming. And we look at this chart from the last WASDE report, the World Agricultural Supply and Demand, issued by USDA, and we look at corn, global corn. Those orange columns going up and down on the page represent global production of corn. The blue line represents global consumption or the global demand for corn. As you look at that chart, of course, you quickly see that the blue dot is right on top of the orange column, meaning that the world currently is consuming just about an equal amount of corn that is produced. What does this mean? Well, this means there is an urgent need to plant additional corn acreage to have good production so that that production can keep up with world consumption. And that is what is happening now in the markets, and this is what will probably keep corn markets from dropping off very dramatically. We are going to go into the planting season here in the United States in April and May for corn and soybeans, and the market is going to be watching that very, very closely. We're going to be, and we are in a weather market. So in corn, consumption is about equal to production. And currently, we're looking at a stocks to use ratio in corn that's 8.3% this year and projected to be close to 10% for next year, 2022. Keep in mind that whenever supply and demand dynamics, stocks to use ratios get below 10%, the market gets nervous. And when the market gets nervous in this respect, it doesn't want to go down too much in price. It gives it more motivation to stay elevated. Looking at soybeans, we see a very, very similar chart to what we just looked at in corn. World production versus world consumption, and the world is consuming pretty much all of the soybeans we produce. So again, we globally need additional soybean acres in order to keep up, and good yields, therefore good production, in order to keep up with current levels of consumption. So both corn and soybeans are not really in a surplus situation. We're just growing and producing as much as the world wants to consume. Not much breathing room there, not much area for comfort, and global soybean stocks to use ratios right now are about 8.5% stocks to use. Again, below that 10% level, keeping the market rather nervous. Wheat. Well, we see something a little different on the wheat chart, and that is that global consumption has exceeded global production in this year. We are actually we're consuming more wheat than we produced last year, being able to go and eat through a little bit of the reserve stocks from the previous year. But again, a very tight situation, tighter on wheat at the moment than we saw on corn and soybeans. So again, we have to make sure, the market has to be comfortable that we will produce more wheat, plant more wheat, have good yields, have good production in order to keep up with demand. So all three of those commodities, corn, wheat, soybeans, are in a very tight situation that urgently need continued good production. Leaves us into a very much a weather market, and as weather conditions promote or detract from production, the market is going to react quickly. That's a quick overview. I hope it's been helpful. Later, if we have time for question and answer, I'll be happy to answer any questions you have. But thank you for your time and your attention. It's been my pleasure. Bye.